Who said it was going to be easy? Defeating a pandemic, bringing an economy back from cardiac arrest, weaning us all off of unlimited government support. Well, it turns out it isn't that easy. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on inflation that won't go away as he predicted.
Now we see inflation becoming more widespread. I've been alarmed for a long time, and I'm more alarmed now.
Bob Diamond on strong bank earnings and what they tell us about the recovery. And Bob Prince on what investors need to do in a world awash in liquidity, knowing it can't last forever. This week was all about coming to terms. Come to terms with inflation that, whether transitory or not, is not going away anytime soon. Here's BlackRock's Larry Fink.
Do I see persistence in inflation? Yes. I believe it's more than transitory related to supply chain issues and commodity prices.
Coming to terms with supply chain problems. President Biden confronts the crisis.
This is the first key step toward moving our entire freight, transportation, and logistical supply chain nationwide to a 24/7 system.
Coming to terms with banks making lots of money, but facing some questions about loan growth and new regulation.
Are loans a little less than they were then? Sure, but year over year, the loans are basically flat. They've grown 2 quarters in a row and are building. And on the deposits, it's been 15% growth year over year, 12% growth, those types of numbers. So that's not the question. And then on investment banking fees and those things are at record levels. And core loans are starting to build, and that's all going to bode well for us.
I see our future as this combination of the balance of the speed of the investment bank with the ballast that wealth and asset management give us, but both really scale businesses, both, number 1 or 2 or 3 in each of their categories around the world, wealth and asset management combined and institutional combined.
And the markets? Well, they certainly came to terms this week with whatever the news brought, with equities rising, buoyed by those strong bank earnings and shrugging off questions about inflation and supply chains. As the S&P 500 was up 1.8%, the Nasdaq was up more than 2%, while the yield on the 10-year came down a bit, ending up about 1.57 after ending last week at 1.6, and the dollar gave back some of last week's gains as well. To take us through what the markets had to teach us this week, we welcome now Bob Diamond. He's Atlas Merchant Capital founding partner and CEO, and Liz Ann Saunders, Charles Schwab Chief Investment Strategist. Welcome to both of you. Liz Ann, let me start with you. What did you see in the equity markets? As I say, they came back this week, but it's been a little bit of a roller coaster since August.
It has been a roller coaster. There's not a shortage of risks, I think, with which the market is grappling ongoing, Delta virus, as well as the supply chain issues, but also the can kick of the debt ceiling negotiations may actually make the situation a little more difficult once you get to December. But I think technically, and even to some degree based on sentiment, you probably got to an oversold condition. And I think really important right now what the equity market is keying off of is relative stability in the bond market. And even in the face of fairly hot inflation numbers, when you have that 10-year treasury yield staying in the 1.5 and change, I think that helps to calm some of the concerns with which the market has been grappling in this era of higher volatility for the past couple of months.
So, Bob Diamond, you wrote recently about coming off the boil, as you put it, in terms of both monetary support, as Liz Ann just referred to, but also fiscal support. What does that mean for equity markets at this point?
Listen, we've had, just a Goldilocks period with both significant fiscal stimulus and even more significant monetary stimulus. I think it's pretty clear now from what we've heard from the Fed that what we talked about, 2 or 3 months ago is that tapering is about to start. It's likely to go through the middle of next year and probably be complete. And keep in mind that the Fed has been buying, a lot of U.S. Treasuries and a lot of mortgages, and that's had a big impact on the yield curve and on interest rates. And I think it's in the market, David. I don't think anyone will be particularly surprised. On the fiscal side, as we've talked about, $5 trillion in fiscal stimulus during the COVID period. If there's not more fiscal stimulus coming after that, in essence, it's a tightening. So the market has to weather a number of challenges, but I think paramount among them is the beginning of the tapering.
So Liz Ann, let's pick up there. We hear from so many people that the equities are really being supported to a large degree by that low yield as a practical matter, all that economic stimulus. What is priced into the market right now in terms of, for example, the yield on the 10-year?
Well, I think our view is that the path of least resistance for yields is a bit higher. You probably have near-term ceiling at around the 174, 175, which is where we peaked out at the end of March. But we think you probably edge up closer to 2% next year. Now, of course, the data both on the growth side and the inflation side can change that. But in terms of longer yields and the impact of tapering, I think one of the forces that's been at play, maybe under the surface, that doesn't get all that much attention, is a lot of the drawdowns that occurred even within indexes like the S&P and the Nasdaq this year, and significant drawdowns in non-traditional segments of the market where speculative froth was most excessive, be it the meme stocks or heavily shorted stocks, non-profitable tech. We all know the thematic baskets. A lot of those maximum drawdowns started at the end of February. And I think it's not a coincidence that that was also the point when both M2 money supply and the Fed's balance sheet, if you measure it in year-over-year percent change, that's when the peak occurred. So to some degree, tapering, or some synonym for that, has been in play since late February. And I think it's important because the market does tend to key off rate of change at times more than it does level. And again, I think it's not a coincidence of the timing in that late February period.
Liz Ann, I want to pick up on one thing you talked about, which is the drawdown from the peak in the equity markets, because you had a great chart actually indicating the differential among the S&P, the Nasdaq, and the Russell 2000, because we tend to look at one number for all of them. In fact, there's a big difference in the extent to which they've come off the peak.
Yes, and it also highlights that when we talk about the resilience of the market, that's just, it's only been resilient to the extent you're looking at the index level on a closing basis. And yes, the S&P is up about 18% year to date, but 91% of the S&P has had at least a 10% correction or drawdown at some point this year. And the average drawdown across the entire index is 18%. That's 2 percentage points away from what we consider a bear market. Even more stark for the Nasdaq. Similar percent, about 90% of the Nasdaq has had at least a 10% drawdown, and the average drawdown for the entire Nasdaq is 38%. That's deep bear market territory, but that's the nature of rotational corrections, where you get these pockets of weakness, you get offsetting strength, and it sort of has that wash effect on the index overall. But if you look just one layer under the surface, you'll see that the churn and the weakness has maybe been more in keeping with a lot of these risks that people are surprised haven't had an impact on the market. They have. It's just under the surface.
So Bob, what about that? You know tech so well. You invest in tech. If the Nasdaq's off 38% from the peak, what does that tell us about tech driving the market? Is there rotation going on? Because for the longest time, it really was driving the entire market.
So it has been, and I think one of the things that's bothering that sector, obviously, is more regulatory talk around tech, and particularly big tech. I think some of the actions that have come out of China have impacted that as well. But within tech, we're just still seeing some terrific opportunities.
Yeah, indeed. So Liz Ann, as an investor, I know you don't pick individual stocks. I won't ask you to do that. But if you're stock picking right now, what's the basis on which you would pick your stocks?
I think you want to take more of a factor-based approach than, say, a sector-based approach or a style bucket approach. In fact, one of the important shifts that recently occurred was we saw a rolling over in the earnings revision ratio. This is for the overall market. And that suggests that we're in an environment where companies that have rising earnings revisions have that tailwind in terms of earnings when earnings growth is starting to slow a bit. That ends up almost being a hybrid growth and value set of characteristics, because if you've got improving earnings revisions, it also means your multiple is coming down. And I think you can apply that type of screening, if you want to call it that, across the spectrum of sectors. You don't have to just make a growth versus value decision. And I think the sector rotations have been so dramatic. To try to get in front of that and anticipate those leadership shifts, I think is a fool's errand. And then the other strategy that's really beautiful in an environment like this is rebalancing. When you have these rotational corrections, bigger swings across sectors, it gives you an opportunity to add into weakness and trim into strength.
So Bob, a version of the same question to you. I mean, I think most people believe the market, the equity market, is pretty fully valued. It's certainly up there. Where are the bargains at this point when it comes to equities, do you think?
So I'm going to back up just a little bit to what Lizanne was talking about in terms of the interest rate expectations. I really agree with what she said, and I don't think the market right now has factored in that the 10-year will be 2% or above. We've talked about this, but I think that 1.5% to 3% range has been the range of the 10-year for a long time, 10 or 15 years. Very few periods has it been below there. Recently, it's been below, above, as you said, just above it. We would expect tapering will be a part of this. Also, some of the economic surprises for the first time are coming out negative in all three regions of the world. So our expectation going into next year is that we're going to look at 2% or above in the 10-year.
Well, let me pursue that with you, Liz, and just for one last question here, which is, in your judgment, at what point does the equity market start to really hurt with the 10-year? You said you're anticipating something around 2 as we get into next year. At what point does it really start to bite?
I'm not sure it's a level. I think it's a function of what is driving yields higher if they go up. If it's much more because of the inflation picture and less so because of growth, that would be a bit more of a toxic stew for the equity market versus if we started to see a lift in growth and actually more subdued inflation. I think really key to watch is the correlation between yields and stock prices. It recently dipped back in negative territory, and it hasn't spent much time there for the past 20 years. Whereas the 30 years prior to that, we were mostly in negative correlation territory in terms of yields versus stock prices. So that's what I would also pay close attention to, especially if you're trying to get a sense of, are we moving into a different regime from an inflation perspective?
Lizanne, always great to have you with us. That's Lizanne Saunders of Charles Schwab. Bob Diamond of Atlas Merchant Capital will stay with us as we dig into those bank earnings and why they came out so strong this week. That's next on Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Weston. It was a big week for bank earnings, with report after report coming in better than expected. And although there was a range of reasons for that, when we talked with some of the big bank CEOs, the one thing they all could agree on was inflation, and that it is not going away anytime soon.
I'd be much more hawkish. I would have brought rates up, certainly by the first quarter of next year, I'd start moving. They have a lot of capacity to move, and I think you've got to prick this bubble a little bit. Money's a bit too free and available right now.
Right now, that inflation is clearly not temporary, and as people worry about, it's more permanent. And the way to conflate that is start to get to work on it.
There's real wage inflation across all aspects of the economy right now, and there's certainly, because of supply chain constraints, inflation and other inputs to a whole variety of products and services. And so I think this is something to watch very closely. It's not baked in the cake as to how this will play out and whether or not it will be a significant issue as we go forward, but there is definitely inflation.
Bob Diamond of Atlas Merchant Capital has stayed with us to give us his broader perspective at the wind beneath the big banks' wings and whether that inflation hurts or helps them. So, Bob, how does inflation cut against or with the banks at this point?
So I think I agree with everything that's said in terms of, is inflation going away? Is it temporary or is it here? I think the different perspective, David, I would have is if you look at the core inflation numbers in August and September, they were actually down quite a bit. And while inflation is here, my sense is it's in the 2 to 3% range. I think 2 to 2.5 is exactly where the Fed wants it. So I don't think this is going to be as disruptive. If I'm wrong on that, and it's significantly higher than 2 to 3%, then I would change that, the conclusion of that. What does it do? I think there's a couple things that are happening that are pretty positive for banks. One is investment banking, which I'm sure we'll talk about. I mean, those numbers in the investment banking portion of the bank's earnings were just absolutely very, very strong. And the other thing is, if we get higher rates and steeper curve, inflation will be one of the things that helps lead to that. The tapering ending will help lead to that. Listen, higher rates and steeper curves are just plain good for financial services businesses.
So let's pick up on that specifically, because there was a time when we could not have a discussion of bank earnings without talking about the yield curve the whole time. And we needed to be steeper, and the banks can't make as much money because it's a flat yield curve and rates are so low. We didn't hear that much talk about this time at all. Are these still banks? Are they still lending money?
Well, it's such a couple of different stories. So let me take a crack at a couple of pieces, but it is a couple of stories. If you look at J.P. Morgan's earnings, and it was something like 11.7 quarterly revenue. Take the 2.1 of provision right back out of that, and you're about 9 billion. And of that, 3.3 billion, so well over a third of it, almost 40%, was advisory fees in the investment bank, not sales and trading. So, you know, the thing you're talking about with the steeper curve and all that, these are advisory fees. At Goldman Sachs, the advisory fees were 3.7 billion in the quarter. So this was a quarter, you know, we talked about how much money is out there and the equity levels. This was a real deal maker's quarter, and the numbers were very, very strong. It brings up another thing that I think is very interesting for the U.S. banks if you're looking at them. All 5 of the big banks, particularly Goldman Sachs and Morgan Stanley, are truly investment banks or more asset management and wealth management businesses. But even the big 3 legacy commercial banks have very, very big investment banking operations and have been huge in their earnings. And you think back to the decisions that the regulators and political leaders in the UK, Europe, and Switzerland made post the financial crisis, and the demise of the investment banks in Germany and the UK and in Switzerland. And this is literally a U.S. play right now. So the impact on the U.S. banks has been absolutely terrific.
So let's pursue that investment banking on 2 fronts. One is how much of the deal making is just because the rates are so low. So the cost of borrowing to do a big deal is almost zero at this point, encourage you to do it. And the second is what you just said, almost a moat around the business, almost literally the North Atlantic.
Well, it's
a moat around the business.
It's kind of an oligopoly right now for the U.S. banks relative to the competitors coming from overseas. But you know, it's plentiful money. It's very low rates or free, and certainly that's had a huge impact on the ability to get transactions done. That and valuations being at, I'm not saying they're overdone, but they're certainly at good levels relative to the last couple of years.
So what does that say about the future for U.S. banks? I mean, a Bank of America, for example, has huge deposits, which gives them a lot of capital they can use in other ways, make money off of. They're going to have to stay as deposit-taking institutions in lending, or are they going to integrate, particularly as we have fintech coming in and a lot of disintermediation?
So the positives are investment banking. The positives are higher rates. But there are some concerns and there are some headwinds. If you take the investment banking operations away from the commercial banks, the larger commercial banks, and look at their core banking business, that core banking business is under threat with higher costs. It's under threat with the need for more technology. It's under threat, as most of the CEOs talked about, much lower loan growth, but also a lot of the lending being done by non-banks, by specialist firms. And then finally, they're under real attack from technology platforms. Particularly, it has been that case for a number of years in the retail sector with PayPal and Venmo and all of that. But now with companies like Circle, you know, that digitization is happening in the commercial activities in terms of large commercial transactions, treasury and transaction services. So one of the numbers that I watch is in the U.S. In 2008, prior to the crisis, the market cap of financial services was about 95 or 96% the banks. Today, the market cap of financial services in the U.S. is about 70% the banks. And it's the specialist firms and particularly with the strong technology platforms that are really taking a lot of the income away from the banks.
And just briefly at the end, tell me, if you're a CEO of one of these big banks, how do you look at the margins? Where do you need to really invest in order to keep the margins up as opposed to have margin pressure?
So I think the challenge is it's not a lack of deposits, as Brian said. I think the banks are more concentrated and larger today. The big banks in the U.S., I think it's 50% of the deposits in the U.S. are with the 4 largest U.S. banks. So it's really around keeping the technology and the cost side up with the specialist firms and the technology-led firms. I think that's where it is. Now, that larger amount of deposits will feel a lot better as rates rise and the curve steepens as well.
And very briefly at the end, maybe the big question, can they keep up on the technology organically? Or does that mean some of these banks have to take some of the capital generating and make some big acquisitions?
So I think we've seen it with J.P. Morgan in the last quarter. I think there was 1 big acquisition in the UK and I think 2 in the US. So I think we're going to see that. We're going to see many of the banks invest in technology via acquisitions.
Which will help somebody's investment banking someplace, right? That's another
There you
deal.
go again.
Exactly.
So
another way to make some fees.
More investment banking fees. And it will be the U.S. banks getting them.
Exactly. Thank you so very much. It's great to have Bob Diamond with us from Atlas Merchant Capital. He's the CEO and the former CEO of Barclays. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time to take a look at what is coming up next week on Global Wall Street.
Thanks, David. It is all about getting a pulse check on China's economy this week when third quarter GDP is released, along with September activity figures. The power crunch is adding to a slew of headwinds facing the economy, prompting the likes of Goldman Sachs, Bank of America and Fitch to cut their growth forecasts for the world's second largest economy. There's also the Evergrande concerns lingering. A $19 million bond payment is due this week. And we'll also see how other economies in the Asia Pacific are faring, with Japan and New Zealand among those reporting inflation data. Plus, South Korea's export numbers for the first 20 days of October will be worth watching for the signal on global demand.
Earnings season in Europe kicks off next week. We have the likes of ASML and Barclays both reporting, along with a whole host of others. And then on Friday, EU leaders meet for a summit on topics ranging from COVID to the energy crisis.
The big economic data next week in the U.S. include housing starts, building permits, and existing home sales, all offering insight into a real estate market trying to maintain growth amid disruptions from labor shortages, scarcity of building materials, and now rising mortgage rates. Corporate news in the week ahead include more earnings from a wide swath of industries that should provide additional insight on economic conditions. Notable names to watch include Johnson & Johnson, Halliburton, Netflix, Biogen, and Railroad CSX, as well as Tesla, Whirlpool, Southwest Airlines, Chipotle, and American Express. And keep an eye on Apple and Alphabet. Neither reports earnings next week, but both plan product launches at a time when supply chains have made it harder to meet production targets. Apple's event, it includes a MacBook redesign, while Alphabet is going to launch a new Google Pixel 6 phone. David?
Thanks to Juliet, Danny, and Romaine. Coming up, what's an investor to do with all this liquidity sloshing around in the markets? We get the long-term view from Bob Prince, co-CIO of Bridgewater Associates. That's next on Wall Street Week on Bloomberg.
We're all in territory we've never seen before. Since the great financial crisis hit in 2008, the U.S. government has intervened in the economy in unheard of ways, with the Federal Reserve keeping interest rates near zero while buying up bonds in the hundreds of billions of dollars, as Fed Chair Jay Powell defended once again just last month.
We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate.
And according to ECB President Christine Lagarde, Europe isn't far behind when it comes to monetary support for the economy.
We're not out of the wood yet, and we have to continue to show resilience, persistence, and continued cooperation.
But monetary support isn't the half of it. Governments have now stepped up with trillions of dollars in fiscal support and are considering trillions more, which former U.S. Treasury Secretary Mnuchin says is concerning.
I think, to the extent that some of these other programs get passed, will be up to 32, 33 trillion. I think 140% debt to GDP is a very dangerous issue.
So what are the effects of all this? Frankly, no one is quite sure, with some more than worried about inflation, like Larry Summers.
I do think we're in very serious danger of repeating almost all the mistakes of the 1960s and early 1970s.
And BlackRock's Larry Fink this week agreed that it isn't all transitory.
Do I see persistence in inflation? Yes. There's, I believe it's more than transitory related to supply chain issues and commodity prices.
While at the same time, we still have unemployment at levels we shouldn't have expected, leaving investors looking for a roadmap when it's a road no one's ever taken before. Or, as Chair Powell admitted to Senator Kennedy in February, all that we learned in economics doesn't necessarily work anymore.
When you and I studied economics a million years ago, that M2 and monetary aggregates generally seem to have a relationship to economic growth. Right now, I would say the growth of M2, which is quite substantial, doesn't really have important implications for the economic outlook.
Long-term investors need a roadmap in this brave new world. And to help us put that map together, we welcome now to Wall Street Week Bob Prince, Co-Chief Investment Officer of Bridgewater Associates. Welcome. It's great to have you here, Bob.
Thank you, Dave. It's good to be here.
So you're concerned about inflation, I think it's fair to say. You think we have inflation and it's here to stay. Give us where you think we are in inflation and what should be done about it.
Well, yeah, we think that inflation pressures are building, not fading. The assumption of the markets and the central banks and so forth was that this was sort of a one-off, idiosyncratic issue. But what's really happening now, you see increasing evidence every day that demand is outstripping supply in a number of areas. Labor markets, wage rates are up. The statistics the other day were that there are 11 million job openings in the United States and aren't even that many unemployed people. So you've got a supply-demand issue in wages, energy and raw materials. You've got low inventories. You've got supply-demand pressures in housing. And when you look at just the CPI, 30% of the CPI is housing. It's either actual or imputed rents, and it's lagging the rise in home prices. So more is coming there. So pressures are building for inflation, and a big part of that is that there's a tremendous amount of inertia in the economy from what we refer to as MP3 policies that were just referred to in your segment, which I think would be good to go into. And I think the net of it is that the current policy posture is not sustainable for long.
So let's pick up specifically on MP3 and the dramatic growth. I mean, it's been quite extraordinary. And yet, I don't think it's been reflected in the level of inflation you normally expect, given how much more money there is in the system.
Well, maybe I could explain what I mean by MP3. It's sort of a buzzword, right?
Yeah, sure.
So, we're mechanics. We try to understand the economy and the markets is like a machine. And so the cause-effect linkages of that machine and sort of what would be the next shoe to drop, basically. And MP1, or Monetary Policy 1, is an interest rate-driven monetary policy. That's what we're all used to. MP2 is a QE-driven policy, which was, post-financial crisis. Those are both fully spent. You can't. The interest rate policy works if you can cut interest rates, but you got to move them by 300 to 500 basis points to have an effect. And the way that interest rate policy works is that you change interest rates, you change demand, and then that changes people's income because spending drives income. But the goal is income, right? When you go to MP3 is fiscal policy supported by monetary policy. So it's the government borrowing money, the central bank printing money, buying the bonds, and then the government piping that money into the economy. And what's really important to understand about that MP3 is that the cause-effect linkages are reversed relative to normal monetary policy, because whereas typically income is at the tail end of that process, it's at the front end of the process. In other words, you're inflating people's incomes by just simply putting money in their pockets. It's not earned income, but it's income. It's spendable. And if you look back back at last summer, last year when we had the strongest policies, only about a third of that money got spent. A third of it went into debt reduction, and a third went into assets. So there's a tremendous reserve of liquidity out there that continues to come out of bank accounts and spend, and that money was basically inflating nominal incomes. The other side of MP3 is that the central bank suppresses the rise in interest rates. Right. And otherwise, you're pushing the accelerator with one foot and hitting the brake with the other. So that puts you in a situation from an investment standpoint where nominal cash flows and nominal income and nominal spending are very high and interest rates are very low, and there's a really fat spread between those. And like Larry Summers said there, that spread is the fattest since the 1960s and 70s. Yeah. The only question then is how much of that nominal spending turns into inflation versus real growth. But for an investor, it's cash flow. And so that's been a lot of what's been behind the rise in the markets.
So underlying all this, as I understand what you're saying, is a fundamental mismatch of supply and demand. And that's true with money and goods and services and labor and everything else. I'm assuming that that cannot continue forever. Something has to bring that back into alignment somehow. If you're an investor, how do you prepare for that world? Because that suggests that the world 3 years from now may not look like the world we see today.
The thing that brings that back into equilibrium is a tightening of monetary policy. We no longer have the ability to cut interest rates. We got plenty of ability to raise interest rates. And so, we're getting closer and closer to that day. And then the question is, how much of an interest rate increase and when? It'll be sooner than what's discounted, probably a lot bigger. If you look back historically at how much of an interest rate increase it takes to slow down an economy, it's like 300, 400 basis points. Wow. And that's in normal times when, and we have abnormal times because so much wealth has been created. It's nominal wealth. It may not be real wealth, but so much wealth and so much money is sitting in bank accounts that there's a lot of potential spending out there just sitting in bank accounts and sitting in assets.
Well, take me into that world. As you say, nominal wealth has been created. I mean, asset values have been increased, without a doubt. When in a world where you go up 300, 400 basis points, you take some of that value out of those assets. For an investor, where do you go to make sure that you don't get burned by that? Do you go offshore? Do you go to Asia? Do you go to China? Where do you go?
Well, I think first of all, you want to inflation hedge assets because it's very likely that the rise in interest rates will lag inflation and lag the economy. The Fed doesn't really want to get ahead of it. Someday they might have to, but the first move up in interest rates is a rise in inflation as interest rates are dragged higher by the economy, and that doesn't shut things down. It just sort of resets the levels of everything. So first of all, inflation assets. And second, all of the things we're describing about the United States and Europe, they're not true for Asia. And we tend to have a very West-centric view of investing, and yet the economic output of what I refer to as an Asia bloc, which is China plus a number of countries that are trade very closely together, the contribution of that area to global growth is 2.5 times the contribution of the U.S. and Europe in terms of growth rates. If you look at the sizes of the cash flows, the size of credit outstanding, it's equal. And so I like to think in terms of balancing a portfolio between East and West, and of course, nobody's really even close to that.
Okay, to be unfair to you, I'm going to ask a really hard question, but we only have a short time to answer it. Are we looking at a Volcker moment?
No, because you have to have a Paul Volcker to get a Volcker moment. Paul Volcker was a rare person and a great person. But no, that was what was it? 20 years of inflation accumulation, serious pressure on the dollar, serious question of the dollar as a reserve currency, and he stepped in to change the tide. We're at the beginning of a potential problem, and so we've got probably a few central bank heads before we get to that.
Got a little bit of time. Thank you so much, Bob.
Right,
really
David.
great to have you with us. That is Bob Prince of Bridgewater Associates. Coming up, we wrap up the week as we always do with our special Wall Street Week contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. is Wall Street Week. I'm David Weston, and we're going to wrap up this week once again with our very special contributor, Larry Summers of Harvard. So, Larry, inflation back in the news again this week. We've talked about it quite often. What did you make of these CPI numbers? I know that some people said, although the headline number was a little bit alarming, the core number, not so much.
I think these numbers are very disturbing. People have been cherry-picking their favorite indicator in order to say everything's under control for months now. And they did it again, most notably Paul Krugman did it again this year. The one everybody liked on Team Transitory 3 months ago, which was the so-called trimmed mean or the so-called median inflation, which basically took the central component, those numbers were on fire last month, showing major acceleration. Look, we're seeing exactly what you would have expected with a central bank behind the curve. We're seeing an explosion in particular components and bottlenecks, giving way to a more generalized inflation. We saw it in specific components early a few months ago. Those components have receded a bit, but now we see inflation becoming more widespread in a wider range of products, spreading to the housing and labor markets. I've been alarmed for a long time, and I'm more alarmed now.
So, Larry, if in fact inflation is the problem, or at least something we should be addressing, what should the Fed do about it?
They should taper faster than they're talking about. I don't get why anyone thinks there's a need for another $400 or $500 billion in bond purchases in an economy where the Fed funds rate is running at -4%. In real terms, in an economy where we're running very, very large budget deficits, in an economy with a record degree of labor shortage and quits. Tapering should take place in 3-4 months, something like that, and it should be clear that the Fed is ready, if it's necessary, as looks likely, to be moving to tighten much sooner than they've currently talked about.
Larry, this week you gave some remarks criticizing the Fed, I think it's fair to say, for getting distracted, being too worried about things like climate change and inequality. What sort of reaction have you had to that? Adam Posen, for example, from the Peterson Institute, has sort of criticized you for that, saying, no, actually the Fed's not doing enough about climate change.
Look, I think that the Fed's job is to manage money. The Fed's job is not to make a broader society. And more just society. That's the job of elected officials. That's the job of the political process. If there are real and genuine financial risks, that should absolutely be part of the Fed's regulatory mandate. But I'd much rather have seen the Fed preserve the regulations it had than the ones Governor Quarles have loosened, than see it trying to use regulation as a hook to connect itself to the climate change problem. I think that's the better approach. I think the Fed should stick with its responsibilities for macroeconomic performance. And when I see it start to broaden much more widely to social justice or to climate issues, I get nervous, especially when I don't think they've got it under control on their core responsibilities of sound money and low inflation.
And where does that intersection come? I mean, the Biden administration this week, at the end of the week, also came out with a sort of an overall blueprint. It's not clear what the details are, saying we have to address climate change. And one of the issues is financial system resilience. It's not clear whether that applies to the Fed as well, but where is the intersection where actually climate is a matter of financial strength and stability as opposed to trying to change society?
We'll have to look at what the recommendations are. If you're an insurance company and you're insuring homes that are at more risk of flooding, then you absolutely need more reserves. If you're a bank and you're making loans to energy companies that aren't actually going to be able to market their energy, that's something you certainly need to think about when you regulate the bank. But I don't think that going beyond that to try to limit the flow of capital into the use of energy is necessarily the right thing to do. And I have some concerns that at a moment when we're seeing spiking energy prices, and those spiking energy prices are doing a variety of kinds of damage, including to some of the poorest people in the world, the general idea that the thrust of policy should be to deny financing to fossil fuels makes me pretty nervous. I'd rather see more emphasis on reducing the demand for fossil fuels than reducing the supply of fossil fuels. I don't think it's healthy that we're seeing the kind of spike in energy prices that we've seen, and I think that's an important near-term concern.
Another event this week was the annual meeting of the World Bank and the IMF in Washington. Looking at what was discussed, what got done this week, what do you say about the way that these international institutions are responding to some of the global challenges we face?
You know, frankly, with the United States preoccupied by domestic issues, with some of the issues of internal governance in the international financial institutions, with the splits between the United States and China, I have to say it's a bit tepid. I don't think we've seen anything dramatic on the climate change challenge. I think we're still not yet committed to do what's necessary to protect the world against future pandemics. And so I think we marked time a bit this week, and I hope we'll see more boldness in the future. I'm glad to see Kristalina Georgieva continuing her leadership at the IMF. The SDR steps were constructive, but I think we really need more boldness, and that really depends upon the shareholders of the major institutions, starting with the United States.
Hitting a little closer to home, we got some reports from some university endowments this week, including from Harvard, that you're very much identified with. You're not only the Harvard professor there, but also, of course, the former president of Harvard. Harvard didn't do so well. What's going on with that?
Look, endowments are invested in some kinds of stocks or others, and they've gone way up. It's good news. The post-COVID austerity in higher education, there's no need for that on a continuing basis. Universities have billions of dollars today, more than they could reasonably have expected to have today before COVID started. So it's a time when they can invest in distance education, they can invest in providing more opportunity to more disadvantaged people. It's a time when they can invest boldly in science. I do think we at Harvard, whose performance has lagged for a substantial time period, the people who are currently responsible for that do need to do some soul searching on why that's taken place and try to set it right, since it's cost the university billions of dollars.
Okay, let me sneak in one more. Should they start investing in Bitcoin? Because that was very much in the news. That did not mark time this week on news that the SEC appears to be about to approve ETFs for futures in Bitcoin. Where is that going?
Look, I think the right regulatory framework for Bitcoin is that we regulate Bitcoin for all the things we regulate the rest of finance, whether it's money laundering or suitability of consumers who are investing or market manipulation. I don't think we should turn Bitcoin into some paradise of regulatory arbitrage. I also don't think we should be punitive for the sake of being punitive with respect to Bitcoin. We should regulate it as we regulate other pieces of finance, and then let the market decide what its functionality will be.
Thank you so very much, Larry. Always great to have you with us. That's our special contributor on Wall Street Week. He is Larry Summers of Harvard. Coming up, one more thought on the passing of the torch on Wall Street. That's next on Wall Street Week on Bloomberg. Finally, one more thought. choose your predecessor carefully. Henry Kravis and George Roberts announced this week that they will be stepping down as co-CEOs of legendary private equity firm KKR. They are following in the footsteps of David Rubenstein and Bill Conway at Carlyle, and leaving Steve Schwartzman as the only founder of a major publicly traded private equity company still at the helm. When Henry Kravis set out with his cousin to create KKR, they didn't really have a predecessor. Sure, they did have a boss. That was Ace Greenberg of Bear Stearns. And years later, Ace Greenberg admitted that he sort of regretted having let them walk.
I felt very bad about it. I've often said that I don't think we worked hard enough to keep them, although I must say I've regretted it ever since.
And it wasn't long before Kravis and Roberts truly did go their own way, with deal after deal, culminating in that epic takeover of RJR Nabisco in 1988 for some $22 billion. That was a staggering amount back then. And in the process, they created the world of private equity, making Kravis the symbol of a wildly successful and often controversial roaring 80s on Wall Street.
I am not a destroyer of companies. I am a liberator of them. The point is, ladies and gentlemen, that greed, for lack of a better word, is good.
But that was over 30 years ago now, and what was wildly disruptive has become mainstream. While the small shop that Henry Kravis and George Roberts set up with $400,000 and a small group of employees today manages assets worth $430 billion and owns companies that employ tens of thousands of people. And now it's up to two new co-CEOs, Joe Bay and Scott Nuttall, to take their turn at making Wall Street history. They have a lot to work with, and as George Roberts pointed out, they have each other.
At least in our business, if you can get two people working together, it's not easy. But if you can do that, it's much more powerful than one.
But they do have one big burden. That is what their predecessors accomplished. One thing's for certain, they're not going to make their name on one big deal like RJR Nabisco. But their predecessor, Henry Kravis, had some valuable advice for them. Don't be afraid of change.
You know, change is difficult. General Shinseki, who used to be Chief of Staff of the Army, has a wonderful saying in which he says, if you don't like change, you're going to like obsolescence a lot less. And it's so true.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.